First of all, I would like to thank NIPFP to give me this platform. I would also like to thank two anonymous referees for their useful insights and Kavita ma'am for her very useful suggestions. Yes, so I'll be presenting on global financial shocks and monetary policy in India with a focus on role of foreign exchange intervention and macroprudential policy. So first I'll start with what's happening currently and then I'll try to connect with it with the rest of the paper. Now we know that India is adversely affected amid the Gulf War. Rupee has sharply depreciated in last 6 months, making it Asia's worst performing currency. We also see record capital outflows from the country. As we can see in this graph, across all asset classes, we see that capital has been flowing out, the only saving grace being reserve assets. Now, how has the RBI responded? RBI has intervened heavily in both spot and forward forex markets. It is very evident in the fact, in the first panel, we can see that the share of foreign currency assets as the percent of total foreign exchange reserves has been sort of gradually going down since September, which means that RBI has been selling US dollar tremendously. And what we also see is that it has heavily intervened in the forward market. Although we see that has been there from quite some time now, but if reports are to be believed, then in March, there has been a record net forward sales of 104 billion USD. There are other macroprudential and market-based measures which the RBI has used. So in late March, it put a cap on commercial banks' net open position in order to reduce their exposure to unhedged foreign currency risk. And it also very recently, few days back, it removed mandatory 2% investment fluctuation reserve, which is part of the macroprudential toolkit in order to promote liquidity in the banking sector. So what we also see is that RBI has taken some extraordinary measures like intervening in the offshore market through banning non-deliverable forward contracts. Amid doing heavy foreign exchange intervention and using macroprudential policy tools, RBI has been able to keep policy rate unchanged. So RBI has kept policy rate unchanged because it perceives that inflation won't cross the upper threshold of 6%. And also there are concerns regarding growth because major organizations have sort of slashed India's growth rate in current financial year. So then it becomes pertinent to ask whether such policy tools are effective under global financial shocks. So till now, we haven't seen any fresh interest rate hike by Fed in 2026. But what if there is an increase in US monetary policy rates? So are these policies sufficient to sort of safeguard our monetary policy autonomy? And that's what the paper talks about. In doing so, we move to theory of trilemma and dilemma. In 1965, we see the trilemma theory coming up, according to which any central bank has three trade-offs between monetary policy autonomy, fixed exchange rate, and capital account being fully mobile. According to the trilemma theory, at best, we can achieve two objectives from these three policy goals. And more recently, we see the dilemma theory coming up, according to which flexible exchange rates are not completely effective in insulating monetary policy autonomy. And what it argues is that emerging market economies remain exposed through capital flows, exchange rates, and financial markets. And in order to restore monetary policy autonomy, putting macroprudential policy or capital controls is essential. Now, for India, I think it doesn't fit into a perfect dilemma or trilemma situation because firstly, RBI intervenes in the forex markets and it basically tries to stabilize exchange rate. Firstly. Secondly, we see that our capital account is not fully convertible. So we also point to existing literature on it. We draw insights from global financial cycle literature, which argues that global financial conditions strongly influence domestic financial conditions, especially in emerging market economies, which are more vulnerable. And there are studies which show that flexible exchange rates alone are not effective in insulating monetary policy autonomy against global financial shocks. And then there is recent work which emphasizes the coordinated use of foreign exchange intervention and macroprudential policy in order to safeguard monetary policy against global financial shocks. But we do not see any India-specific paper or empirical paper where we see that use of these coordinated policies is effective. Most of the literature, empirical literature on FXI focuses on maintaining stability of exchange rate. And macroprudential policy, majorly it is more towards seeing whether it stabilizes output for Indian case. Now, it brings us to our 4 research questions. First, do global financial shocks exert a statistically significant influence on domestic monetary policy and short-term money market rates? Now, in the analysis, we distinguish between monetary policy and money market rates because, while deciding policy rate, RBI is more strategic and more planned, while we see that money market rates are determined in the overnight interbank money interest rate market, and which might be more impacted by global financial shocks. And also the literature, the recent literature, there is a lot of ambiguity on whether global financial shocks truly exert influence on domestic monetary policy. Second question, to what extent can foreign exchange intervention insulate domestic interest rates from global financial shocks? Then thirdly, we also look at whether FX intervention generate differential responses from policy rate and money market rate. And last question, can joint use of macroprudential policy and FX intervention completely neutralize the impact of global financial shocks on domestic interest rates? These are our data sources. Now for shock variable, we primarily focus on US monetary policy surprises, and they've been taken from Boyer and Johnson. The real GDP growth comes from MOSPI. Also, I would like to point out macroprudential policy indicator. Now, it comes from IMF database, which gives an index on, which gives data on macroprudential policy index, which consists of 17 policy instruments. We also check for other global financial shocks like VIX shocks and global financial cycle shocks. And essentially, we focus on innovation terms in both these shocks. Now, the empirical strategy is linear and non-linear local projection method. So we do analysis on monthly data, which starts from 2016 May, which is essentially when inflation targeting framework officially came into being. And we ended at 2024, December 2024, because, based on data availability. The linear model employed to study impact of global financial shocks, primarily US monetary policy shocks, is used. The non-linear model employed is to examine the insulating role of FXI and MPP. Now, in doing so, we differentiate between two regimes. One is strict FXI regime, which takes on value 1 when FXI exceeds 75th percentile and 0 otherwise, and light regime, which takes value 1 when FXI is at or below 75th percentile and it is 0 otherwise. So basically, we are not only talking about FXI, we are also talking about the varying degree of FXI, how that is important for the analysis. Then we also talk about macroprudential policy, and we are essentially focusing on tightening regime. So the MPP indicator can take value 1 to 17 because there are 17 instruments which are going into the index. Now talking about the linear model, as you can see, the first equation, it shows the linear estimation. The Z term denotes domestic interest rate, which is repo rate, and alternatively weighted call money rate. Beta is coefficient on shock term, which is primarily US monetary policy surprise, and we later go on to VIX shock and global financial cycle shock. Then W is vector of domestic controls, which includes real GDP growth, CPI inflation, exchange rate depreciation, and we also include dependent term in lagged, basically in lags. We also use FXI in lagged term in order to control for endogeneity. Now, in the baseline case, we are not controlling for macroprudential policy because it is not in form of a continuous series which changes according to the global financial conditions. So it's essentially a discrete variable. However, we do include it later when we do the robustness tests. And in the baseline specification, we take 4 lags. We also estimate a non-linear model in order to see the insulating role of FXI and MPP. Now, as you can see, there are 2 regimes. So strict regime for FXI, and then there is light regime. So in this specification, A denotes strict regime and B denotes the light regime. So when there is strict regime, essentially because I is the binary variable, we see that the second half of the equation disappears. And when we are talking about light regime, the first half of the equation, it disappears. So that is how we are able to distinguish between the regimes. Now we have taken certain measures to mitigate endogeneity in the model. Firstly, we rely on externally identified US monetary policy surprises, which are based on high frequency changes around FOMC announcements, because in the recent literature, despite US being the large economy and India being the small economy case, but still, our policies are very much determined about the news which gets gathered around the monetary policy changes. So hence we've taken for orthogonalized US monetary policy surprise shocks. The FXI and MPP regimes are lagged by 1 period to ensure that the regimes are predetermined and there is no, and to limit simultaneity bias. Then local projections are less vulnerable to dynamic misspecification than fully specified VAR models, and this is why we use it here. Domestic controls and lagged monetary policy conditions help reduce omitted variable bias and capture endogenous policy responses, and that's why we've taken all our control variables in lagged term. The state-dependent framework captures transmission across pre-existing policy regimes, and rather than relying on causal regime shifts, where endogeneity might get amplified. Nonetheless, residual endogeneity may persist in the model as policy regimes may reflect broader macro financial conditions not fully observed in the models. So the results should be taken with a pinch of salt and be interpreted as conditional rather than fully structural effects. Now, what we see is that a positive US monetary policy shock increases repo rate by 8 basis points on impact, while the impact on WCMR is more sharp. So on impact, it increases by 15 basis points. The reason being that repo rate is more strategically used by the RBI, and while WCMR is simply determined by liquidity demand and liquidity supply. So because it is market determined, we see that the impact of spillover is very high just at the impact period. Now, both these interest rates increase when there is no active foreign exchange intervention, and both converge to 23 basis points. So the increase is essentially 23 basis points over 12-month horizon period. The impact is persistent, but as we can see, the repo rate, the impact is more linear, and WCMR, the impact is sharp in the starting, and then it sort of normalizes and converges to 23 basis points. Now,
what's the shock? How big is the shock? It's a unit shock.
Okay, yeah. So it's a 1 standard deviation increase in US monetary policy surprise. That's the shock. Now, we see that US monetary policy shock is attenuated but not completely neutralized under strict FXI regime. So the light FXI regime, essentially, it sort of mirrors the linear case where we see that there is no active foreign exchange intervention. However, when there is strict foreign exchange intervention, we see that repo rate just at the impact period, it increases by 2 basis points. And after that, the impact of shock completely goes. So strict FXI regime is highly effective in attenuating the impact of US monetary policy shock, but it is not completely effective because just at the impact period, we see, interest rate rising by 2 basis points. Now, basically, we see the impact on WCMR. So again, we see that the first case where light FXI regime is used, it sort of mirrors the linear case. But after 7 months, we do see the impact going down, and it is perhaps because of RBI sterilization process that liquidity sort of gets absorbed. In the strict FXI regime, we see that just at the impact period, the WCMR increases by 3 basis points, and then it takes 2 months for it to settle down and the impact to get neutralized. So while strict FXI regime is highly effective, it does not completely neutralize the impact of US monetary policy shocks. Now we see the results with tight macroprudential policy instrument. So what we see is that when we interact the tight macroprudential policy instrument with strict FXI regime, we see that the impact is completely neutralized. So, and it becomes statistically insignificant. So as we can see, the non-linear model, so repo rate under strict FXI and strict MPP regime where the MPP or the macroprudential policy is tightened, and the WCMR case where, again, we see strict FXI and tight macroprudential policy regime. Okay. So what we see is that, now I'm very briefly going to discuss about macroprudential policy instruments. Now, these are more targeted instruments. I don't use capital controls in my model, and I focus on macroprudential policy for 2 reasons. One, very recent literature, it says that for global financial shocks impacting monetary policy, macroprudential policy instruments are much more effective than capital controls. Secondly, both theoretical and empirical works show that the output loss, which happens due to tightening of capital controls and macroprudential policy, it is less when we use macroprudential policy rather than capital controls. And these are more targeted instruments which are aimed at enhancing resilience of banks' balance sheet. When we talk about top 5, top 6 instruments which are being used by RBI, we see liquidity measure, which comprises of liquidity coverage ratios and other liquidity measures, capital requirements, conservation requirements, which are a form of capital requirements, additional limits on systemically important financial institutions such as capital surcharges and liquidity surcharges, and loan-to-value limits are most actively employed MPP instruments. So although we have data on 17 instruments, during the sample period, only 10 instruments are actively used, firstly, and among them, these 6 instruments are more actively used. There are also other important results. So not all global financial cycle shocks have homogeneous impact. So I'm not going to show the charts. We can discuss them later. But the result which we get is that VIX and global financial cycle shocks have counter-cyclical impact on domestic interest rates. The reason being because they do not transmit through same channel, as we see for US monetary policy surprises. So these shocks capture global risk of shock. So when there is uncertainty in the system, the businesses might cut on supply, the consumers might cut on demand. And as a result of this, we can see the RBI responding by taking an accommodative policy stance rather than increasing interest rates. Now, what we also see is that US monetary policy shocks have more stronger and more persistent impact than VIX and global financial cycle shocks. In absence of economic stress such as COVID shock, VIX and global financial cycle shocks have no significant impact over Indian interest rates. While if we do not include that period, US monetary policy shocks continue to have an impact on domestic interest rates. What we also see is that while lower intensities of foreign exchange intervention might be sufficient to insulate against VIX shock, strict foreign exchange intervention is effective for global financial cycle shocks. Then we do certain robustness checks. Firstly, we take alternate lags because we lose a lot of degrees of freedom in our baseline model. So we take 1 lag, 2 lag, we do it up to 6 lags, and we see that the results do not change qualitatively. First. Second, we also use alternate thresholds. Like the threshold which I have used for my model is directly coming from literature. But I also, just in order to see whether my results are robust to alternate thresholds, I use 70th percentile and 80th percentile. I do not explicitly check at which threshold the impact starts becoming insignificant. So that would be an interesting exercise. But right now, I don't do such a thing. Then my growth, real GDP growth parameter is quarterly, and I convert it into monthly using cubic spline method. I just to check robustness of my findings, I also include real IIP growth rather than GDP growth, and my results, they remain qualitatively same. Then for US monetary policy surprises, I use an alternate definition, which is US shadow interest rate. Again, the results do not change materially. Then I use alternate definition of FXI by including total foreign currency assets. The results again are consistent. And in the baseline model, I add lagged MPP as a control variable, and the results do not change materially. So there are certain key takeaways from this whole empirical exercise. First, US monetary policy shocks transmit significantly to India's domestic financial conditions, affecting both policy rates and money market rates in a persistent and statistically significant manner. Secondly, higher intensity of FXI is able to insulate monetary policy over a longer horizon. However, FXI is not completely sufficient to neutralize the impact of global financial shocks, because we see that at impact period, it gets impacted. Coordinated use of strict FXI and MPP tightening neutralizes the impact of US monetary policy shocks, and VIX and global financial cycle shocks have weaker impacts relative to US monetary policy shocks. Thank you.
Okay. So this is a very interesting paper. So what the paper does, the main question which is addressed in this paper is that, do global financial shocks transmit Indian domestic interest rate, and can foreign exchange intervention and macroprudential policy provide insulation from these shocks? So the method used, the primary method used in this paper is state-dependent local projections. The indicator for external shocks which are used, the main indicator is the US monetary policy surprises. So this is basically taken from the Bauer and Swanson 2023. So this is basically the paper. The data strips out the information effect of the shock by looking at the effect of the shock in the immediate period around the FOMC meeting. So basically it strips out the information effect, and you have the pure shock effect. Then it looks at the CBOE volatility index, the VIX, innovations, which is basically taken as the AR6 residuals, and then the global financial cycle based on Miranda, Agrippino and Ray 2020. The domestic outcomes which are being looked at are the repo rate and the weighted call money rate. The state variables which are included here is the FXI intensity. So strict is basically defined as above 75th percentile of FXI GDP ratio. And for the MPP, the author looks at the IMAP database, and there's basically two states, tight and other. The sample used for this paper is May 2016 to December 2024. So approximately you have about 104 monthly observations. So the main finding of the paper is that one standard deviation US monetary policy shock raises the repo rate by 8 to 23 BPS over 12 months. And for the weighted call money rate, it rises by about 15 BPS on impact. Strict FXI dampens transmission over time, but does not eliminate the immediate impact. But along with the policy, and there's a distinction being made between policy rate and the market rate, where the repo rate shows a greater insulation, whereas weighted call money rate responds sharply on impact, but and which is consistent with the argument about financial and liquidity channel. So the main headline result is that the strict FXI combined with MPP tightening effectively neutralizes the transmission of the US monetary shock, and responses become statistically indistinguishable from zero. And these results are robust to alternative lag structures, FXI threshold, binary versus count MPP, and alternative shock measure. So I'll start with what is genuinely good about this paper. First of all, the topic is timely and policy relevant. There's a large debate around the IMF integrated policy framework. So earlier, the IMF largely recommended floating the currency, but then in the last about 10 or 12 years, there's been a large literature, starting with, I think, Helen Ray's seminal work on which argued that instead of trilemma, you actually have a dilemma, either to have capital control or no capital control. So this is a very timely paper in the context of the debate. The identification of the shock is credible because the Bauer and Swanson methodology correctly strips out the Fed information effect. So it is better than using the raw federal fund rate. The empirical framework is robust because the local projection method is more robust to the model misspecification compared to, let's say, the structural VAR method or other fully specified VAR models. And there's a distinction made between the policy rate and the money market rate, which is novel for India because most of the papers looks at these two channels separately. And most importantly, we have the foreign exchange intervention and the macroprudential policy in a single framework, examining both tools jointly and their interaction, which is a useful and policy relevant contribution. So, and the headline result is attractive. It is a very sharp result. So my comments are basically about how much weight it can bear, how robust are these results. So my first comment is regarding what exactly is being identified. Now, why is this question important? Because foreign exchange intervention and macroprudential policy, these are both policy responses. These are not randomly assigned treatment. So RBI intervenes more precisely when it anticipates, and because RBI is a forward-looking organization, so it intervenes more precisely when it anticipates a larger external shock. For example, capital outflow or exchange rate pressure or dollar funding stress. So now, lagging the FXI regime, which is something which this paper does, it addresses the timing issue, but in my view, it doesn't address the selection issue. So the instrument is correlated with the severity of the shock environment. So this gives rise to two valid interpretation from this result, and they differ in policy implication. First of all, there can be a causal interpretation that FXI reduces shock transmission, but there can be a conditional interpretation that interest rates behave differently during the high intervention states, which also happen to be the high stress states. So therefore, the question that I think the author needs to address here is that do pre-shock fundamentals like the exchange rate pressure, the capital flow conditions, the reserve adequacy, do they differ systematically across different FXI regimes? So a balance test or a robustness test, maybe to an instrumental variable or for FXI intensity, might help in addressing this question. Secondly, there's comment about the sample size and the related neutralization claim. The total sample is of a size of about 104. Now, the way this strict FXI regime is defined, and so first of all, we must remember that this is a relative scale. So it doesn't absolutely define the strictness of the FXI regime. It's a relative scale. And because of the way it is defined, strict FXI will have about 26 observations. I think later on in the robustness check, I think you also look at 70th and 80th percentile. So 70th percentile might have a slightly higher number of observations. But then once we bring together strict FXI and MPP tightening, then the overlap might have even a smaller number of observations. I don't know, the paper doesn't report exactly what is the number of observations, but it is likely to be very few episodes. So with just small number of observations, it might have because the standard error would be high, so you might have a wide confidence intervals. So it's very easy to not reject zero. So therefore, the question that we need to address is, first of all, is the response significantly different from zero? And is it significantly different? Is the response in a strict FXI, is it significantly different from a light FXI response? And is the attenuation, we know that there's an attenuation, but is it economically large? So, given this observation, I think a safer formulation of the result would be that a combination of FXI and MPP substantially attenuates transmission, with the response become statistically indistinguishable from zero in the estimated specification. Because it's, I think, given this, it's difficult to generalize the result beyond the estimated specification. The third comment is about the mechanism, because the paper invokes multiple channels. So it talks about the portfolio balance, the sterilization, the signaling, the bank balance sheet. But the paper only studies the interest rate outcome. So it cannot currently distinguish between the different kind of channels, like the exchange rate stabilization channel, the domestic liquidity or sterilization channel, the signaling channel, or the bank balance sheet funding cost channel. So one possible way to go about this could be, you can think of adding impulse response for the intermediate variables as well to trace the transmission chain. For example, you can look at the exchange rate, the call money volumes, or the RBI intervention volume, the banking system liquidity, or the credit spread. So by looking at the intermediate variable, it might be easier to understand the exact channel through which this operates. There are minor comments regarding the FXI measurement. These are basically clarification that how do you measure the FXI measurement? Is it the spot dollar sales, or you also consider forwards and swaps? And how do you take account of sterilization? Because the result may be sensitive to whether the intervention is measured in terms of purchases or sales or net. The MPP, the IMAP count actually is a very coarse measure, because it considers a number of instruments and it bunches them together. So therefore, it might be interesting to also look at whether the neutralization result hold for certain specific MPP categories, rather than looking at the MPP as a whole. And we also need to remember that FXI and MPP, there might be collinearity, because both instruments are likely to be co-deployed during the same stress episode. For example, let's say when in 2022 post-COVID, when Fed tightened, there was a tightening cycle. So therefore, reporting the overlap directly could clarify whether the joint effect is separately identified. Regarding the monthly GDP, I think you already addressed it. I think you looked at other measures other than cubic splining. And of course, there is a minor point about figure labeling, that I think the IRF, the vertical axis should also be labeled, whether it's basis point or percentage point. And also in the VIX figure, I noticed that the confidence interval is encompassing zero throughout the figure. So that is something which I think is worth noting about, because that is something which is important for the result. There's a regarding the shock series, because the method which is used by Bauer and Swanson, it covers the FOMC meeting. So there's this question of what happens in the non-meeting months when the FOMC doesn't meet. Because it's the BNS series is even level. So what happens in the month where there are no meetings? Because there are policy signals which also arrives between the meetings, like the Fed chair speeches, the congressional testimony, and other examples. I would be interested in knowing that this BNS sample, it ends in 2019. So how do you extend the data beyond 2019? Because this was a very important period where you had this COVID emergency occurred, you had zero lower bound, you had the 2020 to 23 tightening cycle. So this was a period when the Fed communication was the most important. So whether you used it, whether we were able to cut out the information effect for this period, or are you using the course Fed funds rate for this period? So this is something which I think is important. But the bottom line is that what the paper does well. It's a timely question. There's a credible shock identification. There's a novel policy and money market distinction, joint FXI and MPP framework. The headline result is attractive and policy relevant. But the three things which I think would strengthen the paper, first is regarding the identification, whether the FXI effects are causal or conditional. In terms of diagnostics, the report observation counts per regime and test whether the FXI and MPP response differs from the strict regime differs from a light response, not just from zero, but whether they differ from each other. And also to show the mechanism, by looking at the intermediate variable, whether the transmission channel can be identified. So in sum, the monetary autonomy in India is conditional but not binary. The paper shows the FXI and MPP can attenuate the global financial transmission, but the neutralization result rests on a short sample, co-deployed instruments, and channels inferred rather than identified. Thank you.
Thank you, Dr. Dutta. Kavita, do we have time for question and answer, or do you want to tell us?
Yeah, I think we let her answer and then we'll do pilot.
Yeah. So yeah, please.
So I'll just answer the main questions. Firstly, this is a work in progress, and I'm definitely planning to do an SVAR IV and see the transmission channel, because I think I state that I do not explicitly test for the transmission channel, because I wanted to just focus on the main findings there. In the robustness, I do a test on strict minus the light regime, as you suggested, and we do see statistically significant results. So that is something which I did. On the Boyer and Jones, the shock, basically. So it's orthogonalized re-estimated shock for the full sample, and it's available on their website. So the series, yeah. It's till 2024 December, and due to that, my sample is restricted to 2024 December. So the other thing is that why I take this sample period, because the main important question in my paper is that whether monetary policy autonomy is safeguarded. So inflation targeting came in May 2016, and that's when we started focusing on inflation. And so interest rates were only, they were essentially responding to inflation and growth growth, basically, and not what's happening outside and exchange rate pressure and all. So that is why I included that sample period. So I know there are certain limitations to it, but I really wanted to see what's happening in that time, because that's when we adopted inflation targeting. I think, yes, and also on which MPP instruments are effective. So what we see is that India, as I mentioned, India hasn't been employing all the instruments. 10 instruments India has actively employed. Among them, 6 are very actively employed. So essentially, my hunch is that those are the instruments which are more effective, which comprises of liquidity measures, capital measures, conservation buffer, and there are reserve requirements. So, yeah.
Thank you. In the interest of time, we'll have to bring this session to an end. There's a second session and last session moving forward. Just a last comment. We've heard two papers on two parts of what we call stabilization policy, fiscal policy and monetary policy. I think there's an interesting similarity to the two papers. They're pointing out that there are novel interlinkages between various kinds of policies which can have long-term effect. In the fiscal paper, it was the effect that social infrastructure brought in, and in this paper, it is about macroprudential policies. So with that, I'll bring this session to an end. Thank you.